For equity, we have the lowest priority. So this is again in terms of priority, debt holders always have the highest priority. They get paid first, and this makes less risky for them. In terms of maturity, fixed maturity versus infinite maturities for equity, and debt holders do not have any management control, while equity holders have management control. So why we talk about these differences? Because we see that the factors that matter after will be linked somehow to these characteristics. This is what makes them, what makes a company maybe want more debt or more equity. And from there, we can see different categories of debt and different categories of equity. So debt, for example, we can have bank debt, so borrowing money from banks. We can issue bonds in the market, or we can have what we call commercial paper, which is kind of financial security also in the market, but it's a short-term security issued by companies. Okay, so it's also borrowing money, but over the short term rather than the long term. You have on the other side the equity. So what do we have as equity? Owner's equity, so simply money brought in by the owners of the business, or venture capital. So we discussed venture capital. What's venture capital? We mentioned it last time. What do you mean by venture capital? It's capital, yes, for new businesses, to finance new businesses, but what is particular about this capital as compared, for example, to owner's equity? It's still equity, right? Why we call it venture capital?
Is it raising the money from the public?
No, it's not from the public. It's from specific investors who are the venture capitalists. So these are like pools of investors that will gather and form a fund. We call it venture capital fund. And these funds are specialized in funding, in financing new ventures, mainly startups. Okay? So their main business is to give money to startups. Now, Khalifa Fund can be seen as an example, but it's a little bit different because it's backed by the government, and it's more like
sovereign fund.
It's more like
support, more than
support, yeah, rather than like a business-oriented or for-profit-oriented fund. I think, right? I don't think it's a for-profit. It's more like to support the economy, to support the new ventures, etc. But it is kind of, yeah, it's the same idea.
Financially supporting the startups.
Yes, exactly. It's to support, but the source of the money, the origin of the money is different. Khalifa Fund, the money is coming from the government, right? While venture capitalists are private investors who pool their money, and their business is to give this money to startups. They become, of course, equity holders of these startups. And what I explained last time is that they don't invest for the purpose of remaining equity holders forever. They invest with an idea in mind, the idea to leave after a few years, so 5 to 7 years typically. So they will have an exit strategy. They will assist the new venture financially and in terms of management. They will bring the know-how also usually. Okay, so they will the assistance they provide is both financial and management-wise. They benefit because they will have, as I said, an exit strategy. The exit strategy consists of having in mind a certain return that they will achieve after 5 years, let's say. Okay, so they will be willing. They, of course, they do their due diligence, and they will do their calculation, and they will be willing to invest if they, for example, think that they will be able to get 20% in 5 years by either selling their shares to other private investors, or by, if the company is successful, etc., by going public. So the typical exit strategies are either private placement with other investors or going public through an IPO. So many of the IPOs that you hear about, the initial public offerings, are usually backed by venture capitalists. And usually it's kind of guarantee of the success. So one way to measure the success of an IPO is to look whether it's backed by a venture capitalist or not. Okay, so it's.
Do we have local examples of venture capitalists here?
Name of a fund I can find for you. I can search and find for you. Now I don't have it on top of my head, but there are like international ones that are very well known. I think.
جهاز أبو ظبي للاستثمار ما يعتبر من هذه؟
No, جهاز أبو ظبي للاستثمار is a sovereign wealth fund. It's a fund also, but
They
it's a
just
sovereign
they
wealth
buy
fund.
shares everywhere. They don't really
The
care
purpose
about
is different. The purpose is to invest the government wealth, the country's wealth, to diversify it by investing in internationally in a portfolio of securities and stocks and businesses, etc. Okay, so this is another type of fund. It's a sovereign wealth fund. A private equity fund or a venture capital and private equity are similar somehow. The only difference is that venture capital is
new.
when you have I have an example. I'm very bad in remembering names, but I was reading yesterday an article about a very famous venture capital fund that is backing. I think it's the article I posted for you. I didn't post maybe. I posted some newspaper articles and.
SoftBank? Is it
And
like
it's
SoftBank?
like a venture capitalist that is backing fintech companies now, and I wanted you to read about it because it's like something I talked about also last time.
Is it like SoftBank?
SoftBank? No. There are like a few very large venture capitalists and private equity funds internationally.
صندوق خليفة على private.
Yeah, it's a
Also
private, yeah. Exactly. It's the idea of Sandouk Khalifa, but private fund. Yes, exactly. So what I was about to say, the difference between venture capital and private equity now is simply, it's exactly the same idea. The difference is that venture capitalists target mainly startups. So really like businesses at the very early stage. We call it seed money. Usually they give small amounts of money for the company to start having the prototype, to start launching the idea, etc. So it's seed money. While private equity is when the company is already established and it starts running and it starts commercializing the product or whatever. This is where we bring in private equity money. So it's not the same, it's exactly the same idea, but the nature of the business is different. Venture capitalists are specialized in startups, while private equity will go for medium-sized enterprises that are growing, but it will give them the extra push to grow further and maybe to go public and become international, etc., etc. Yes. So this is the difference between the two, but it's the same idea.
Do you know the website Indiegogo?
No.
It's the same idea. Basically, it's a website where people with good ideas or good startup business ideas, they post their idea and all.
This is crowdfunding.
And all the people they
Exactly.
Not individuals. Yeah.
This is crowdfunding.
Yeah.
It is similar, but here the mechanism is anyone can simply go and give
and
the money. Yes.
Yeah.
So here the difference is that you will not have a management assistance because people will just contribute small amounts
Not
of
even
money,
shares.
but they will not be involved in the management. While private equity and venture capitalists are more like specialized, they will assist the businesses in the management as well to make them succeed.
There is another website, the most famous website, Kickstarter in America.
Yeah, Kickstarter.
Kickstarter is more into like social
Not only social, actually. Recently, I did.
90%.
Even
I
products.
contributed to one of the startups that
Music was.
it's business.
Even products.
It could be.
They don't give you shares, they give you the product.
They
at a
give you the
discounted rate.
product.
It's a rewarding,
So if you
yes.
believe in the product, you can. It's very interesting. You can have it like 50% less, or
We have here in Abu
So,
Dhabi, in Al-Imarat.
and it's a good push for the entrepreneurs. I read the story about entrepreneurs in Canada, I think, and they had this good idea, and I contributed. So it was through Kickstarter.
Yeah.
So you can go and see some ideas, some what people are doing. It's really innovative. These are new ideas.
No ideas where?
Hmm?
In America?
Why not?
لا أنا أبغى هنا.
Yeah, why? So maybe I'm sure there are platforms also here.
Start the same here.
Huh?
We should start the same.
Yeah, exactly. That's then you have to.
We in
that
Dubai,
is, yeah.
Dubai has been regulated and the IFC.
Exactly. That's what I was about to say. For fintech, I know that now there is a big hub in
The IFC
GIFC
are regulating,
for
I think.
fintech companies. So where people finance new startups in financial technologies. Yes.
Yes, and it's based on equity.
And it's
Equity,
now started being big, and valuation is becoming important. So it exists here. Things are moving.
just one of
Yeah. But this is the trend. This is what we were talking about last time. It's really the role of technologies here is very important.
Yeah.
It's going to be the main sources of. There is a shift now from traditional funding through banks and through markets, etc., to this type of funding that is enhanced by technologies, by existing technologies.
So, I just want to the MNEs in UAE, can they consider one of their CSR activities to be like take the same nature of the virtual capital or crowdfunding of startups? Can
Can
they
you repeat
provide?
the question?
يعني can they like have a CSR strategy
Mm-hmm.
based on a crowdfunding or based on venture capital?
Yes, of course. This is a big trend also, especially because crowdfunding, more especially, is very successful for all CSR initiatives. So, because people will be willing to give money if they believe if it's consistent with a belief in CSR. So, it is a big trend now that crowdfunding is used
As
to
a
support CSR activities. Yes, it's this is where it's the most successful. Now we start seeing more crowdfunding for just regular businesses, but when it started mostly for those type of initiatives. Yes. So so this is just to show you the diversity of types of funding that we can have. And you have also something called hybrid securities. We put it in the middle here because it's somewhere in between debt and equity. There are instruments available that companies can use to, again, fund their activities. For example, you have convertible debt, which is debt that can be converted to equity. You have preferred stock, which is also hybrid in the sense that it's not really stock, it's not really equity, it's not really debt. So it's something in between actually. Option linked bonds also, where you have a bond that can be converted. So it is there is a lot of innovation here again, where we can imagine lots of securities to issue stock. Now these are simply charts that illustrate the process of private equity or IPOs, because these are the main funding channels. If we are talking again about a small medium enterprise that is growing fast, that is having a very good product, etc., we may think of private equity, and this is the process through which we can go. I know it's written very small, but the idea is that actually we start with provoking interest of venture capitalists or private equity, depending on the size of the business, the venture. And then, so here, it depends on the type of business. You will see, if you read about these topics, you see that there are some sectors that are more, that attract more venture capital and private equity than others. For example, healthcare is a sector, education, healthcare. These are important sectors that attract a lot of venture capital and private equity. Of course, technologies in general, anything related to new technologies and IT is also something that attracts lots of
Children
funds.
education. Children education.
Yeah, education and healthcare are hot sectors when it comes to venture capital and private equities. And then the stage of valuation. This is a very important step because as you asked, what is the incentive of these venture capitalists or private equity funds to invest? Of course, they have to make money. They are here to make money, and how they can make money if they don't value well the venture that they are putting money in, they may end up losing. So that's why valuation is a very important step at how much they will buy the shares and how much money they will inject and what is the return they expect over 5 years, over 7 years, etc. This is a very difficult task, and this is where their know-how is important, actually. You have to feel the market, know the market, know what kind of return you can get, etc. So there is a whole process for valuation. You have to estimate the cash flows of this project. It's like an investment. You have to come up with estimates and see what is your return and compare it to your target and see whether it's worth the investment or not. And so set the terms of the deal, post-deal management, and exit strategy. So these are details, but just explains in a structured way how these funds operate. The same here for going public. There is a whole process for going public. We talk about IPOs, etc., but you need to know that before we reach there are lots of things to do. It's a very costly process. You have to hire investment bankers. You have to set up a price for your shares. You have to market the shares, make sure that investors will be on board and will be buying it, etc. So it is a whole process. It's not as easy as simply going to the market and selling shares. And the whole process itself is also, again, can be a topic of research. We do a lot of research on IPOs, different stages of the process, how to set the price, something we call, I did at some point research on this for the region. And as I told you last class, now the market is very cold in the sense that we hear about an IPO really quite rarely. It's not happening in a very accelerated way. And that's why, and it's an international trend, by the way. It's not only here, even in US, we have much less IPOs than what we used to have in the past, especially the late 90s, etc. There are different reasons for this. One of the reasons was the crisis, 2008 crisis really contributed to what we call a cold market as opposed to a hot market. And I think also the emergence of these new financing kind of providers, so the venture, the private equity, crowdfunding, etc., led to less IPOs because people maybe prefer this type of financing. They are less costly, we have more flexibility, less disclosure, etc. So so I was saying, I did some research on the region here, and one of the interesting features of IPOs that we observed at that time, at least until, as I said, 2007, it was still, the market was very active. People were very enthusiastic and excited about IPOs because they could make a lot of money. You are from Saudi, right? There was, I think, people who made a lot of money in Saudi Arabia from IPOs. I've seen myself the numbers, and it's amazing. Like sometimes one of the characteristics of IPO, what made them very, let's say, on the spot is, under the spot, is the fact that you can make a lot of money in a very short period of time through something we call the underpricing. It's actually you buy the shares at the issue date when the firm issues them. Let's say you buy them at 10 dirham per share, and you wait a few weeks. Here it's a few weeks, but in US it's only a few days. And as soon as the share hits the market, starts being traded in the market, the price goes up. Okay, and sometimes I've seen in Saudi Arabia, for example, I have specific examples of companies. I have a sample from 1997 to 2007. I have all the IPOs, and in some cases, what we call the underpricing can be sometimes 200%. So it means that in one day, you can make a return of 200% if you buy at the IPO price and you sell immediately when the stock starts being traded. So that's why it was, again, the market was really very hot and lots of people put a lot of money in IPOs. But the problem is that, of course, this is the short-term performance when you hold the stock, when you sell the stock immediately. But if you hold it, what the evidence shows also is that it's the opposite. It's an underperformance. So it means that if you hold it like for 6 months, 1 year, 2 years, you will have maybe a negative return. So the price goes up and then goes down. And this is again something that is documented all over the world. It's not only specific to this region. But the difference is that, as I explained last time, in emerging markets, in less efficient markets, this effect will be exaggerated. So maybe here we can have an underpricing of 100%. In US, it will be 20%, for example. Okay, so it is much more exaggerated here. The average is higher. The gains can be huge, and the losses also can be higher. Of course, we don't always. I'm not saying that everybody who invested in IPOs made the gain, but on average, when we look at all the IPOs, on average, the abnormal return that we can have during those IPOs can be really two-digit numbers. So it's more than 20% usually, which is very interesting, and that's why people were enthusiastic about it. Now, it's not happening anymore. Every IPO becomes a struggle now because companies are not sure about the success, about the timing of the IPO. The market is cold in the sense that it's not favorable for these transactions. You have to wait until you find what we call the window, the right window to offer your shares, because if the market is not favorable, then it can be a failure and it can be a huge loss for the company because, as I said, it's a very costly process, costs a lot of money and it takes time, etc. Management is involved in this process for maybe more than 6 months or a year, so it is a lot of energy and time and money. And if it's not successful, it can be bad for the business. So this is something we can look at, but as I said, I think this topic is now less hot because the market is cold. There is no much happening there. There are not many IPOs happening. I know that here, for example, in UAE, they try to encourage companies to go public. There are different reasons, of course. Why do you think companies here in UAE would be reluctant to go public at this point now? Why we don't see lots of companies? Because in terms of size, in terms of requirements, there are lots of companies that meet the requirement to go public. Yet the number of listed companies in the stock market is still very small. Okay? What is the reason for that?
Is it an economy reason you mean, or is it like a...
Yeah, it's a mix of things. Yes, it could be economic reasons, it could be behavioral, it could be lots of things. Yes.
Like registration requirements, like you need to have a certain number of board members.
Yes,
They meet
yes.
the requirements.
So yeah, the amount of requirements that these companies need to comply with is important. When you go public, I mean, but the requirements you have to comply with is quite are quite important, and this is one of the reasons why companies don't like it, because they know that they will have to do so many things. And the most important requirement is the disclosure, that you have to be completely transparent and inform the market about everything, your financial statements, every single thing that you are doing, and this is something that many companies here don't like. They don't like showing what they are doing for many reasons. What else do you think are there? I know that I think we have a colleague, you can read the article. He did a research on this. I think he published a paper from it. He researched, he had a grant to do this in UAE, and he tried to identify the factors why companies don't go public. So it could be interesting to see what his results are. I didn't look at it, but I have an idea because I read about this topic. So what else could be the reason for that? Risky, again, the timing, yeah. If you miss, as I said, if you don't do it right, it can hit your reputation. That's a good reason. So people are a bit, they have this fear that if things don't go correctly, it will hit their reputation, yes?
Low market return. Low overall market return currently.
The stock market is not doing great, so they think that if they go, maybe the stock price will go down, and it's not gonna be again good for their money and for their reputation as well. And the loss of control also. Here you have lots of family businesses, and family businesses, they want to keep the control. So they will not go public even if they know that this is gonna maybe enhance the reputation, because also going public enhances the reputation. It's you are much more visible, people know about you, etc. But the trade-off for them is, on one hand you lose the control, on the other hand you have more visibility, and they prefer not to lose the control. So this is very related to the type of businesses that you have here, which are mainly either government related or family businesses, and in both cases they don't want to lose the control completely. Okay, so that's why I read about some proposals to have something specific to here, for example, offering a special type of shares, and these exist even in other countries also, where instead of giving the same voting right to everybody, you will keep like the voting rights for the founding owners, for example, the family, the founding family, etc. And you will give shares to the public that come with less voting rights or with no voting rights at all, like preferred stocks, etc. So there are solutions, but things are, I think, not moving a lot at this point because of also the economic situation and economic environment. So it's a mix of factors that could explain this, yes.
And isn't it okay that the company decides how much percentage they want to go public?
Yes, they decide on this.
Then this can happen when they decide if they're going, let's say, for example, 40% or 30%.
Yes.
Then the voting will be 60% or 50% with the.
That's true, but still, like, there is a dilution of the capital when you do this. Even if you keep the majority, you still have your control is diluted. You will have, and also again for disclosure reasons, etc., you will have more eyes into your business. So you will not be completely free of your decisions and your actions. Okay, and you'll have more requirements in terms of auditing, etc. So you have less control on the business.
What is the business benefit
from going public?
Yeah.
Yeah. So yeah, good question. What's the benefit then for going public?
You get a lot of money.
First of all, you raise money. So unless you really don't need, maybe sometimes the companies have enough cash, they don't really feel the need. That's one of the reasons also why maybe when companies have a lot of cash, they don't feel the need for going public. They can grow by themselves, by using their internal cash. So that's one explanation. But if you need the money, going public is a good way to raise more money in order to grow internationally, etc. And as I said, it's more visibility, more the reputation is enhanced. This is also important. So these are the reasons why companies go public.
Is it possible to sell shares without going public?
Yes, exactly. This is exactly this chart here. It's a private placement, we call it. It's you identify investors privately. There are funds again who are willing to invest money in businesses directly without going to through the market.
If you want to combine this with the notion that you mentioned before, if a company wants to keep control of the company, they can sell shares without losing control.
Yes.
What is it called? Like this type of business, do you know?
The type of shares, you mean the
yeah,
special
like
shares?
The type of the shares or the business type which can sell shares privately but also keep ownership.
Well, the share types can have different names in different places. We call them, it depends. Like for example, in some places we will call them type A, type B shares, where each type of share will come with different voting rights, etc. So it depends on the country, etc. There is no specific name. It's more like, think of it as special shares that will give special attributes and voting rights to the founding owners, as opposed to maybe other investors who come later. Okay, so this is how it goes. So these are the types of financing we talked about, and here, as you said, there are different ways also to issue equity, either through by issuing what we call a general subscription. So we issue shares here through IPO or SEO, etc., or through private placement. We sell the shares to private investors. Mostly funds. These are mostly like big, large funds, like BlackRock and important funds that Fidelity, etc. These are international funds. If you look at the ownership structure of companies here in UAE, you will find these funds everywhere in listed companies mainly. I did also some research and I looked at the ownership structure, and you can see these funds having maybe 5%, 2%, 3%, but they will not be like having the control of the firm, okay? And we have also what we call rights offerings. Rights offerings are rights that we issue to give the priority to the existing shareholders in case we want to issue new stock. So instead, for example, if we issue new stock without giving this priority to existing shareholders, let's say I am a shareholder, a big shareholder, and now I'm having 51% of the capital. Okay, so I have just enough to have the absolute majority for all the decisions, right? But if the company decides to issue new shares, of course, with 51%, you get to decide, you get to vote. But if it's less than 51%, if I have 30% and we vote and we end up issuing a new stock, my 30% maybe will be worth much less. If we double the capital, my 30% will be only 15%. So my control will be diluted. The more we issue stock, the less control the existing shareholders will have. So in order to avoid this and to incentivize also the shareholders to bring more capital, okay, we will issue rights. Instead of issuing new stock directly, we will issue rights, and these rights will give the priority to the shareholders. It's like an option to buy the new stock at a privileged price, at a better price. So you will give them this right. They can use it if they want to keep the control, if they don't want their capital to be diluted, or they can sell it in the market, because the right itself has value. Since you are giving, it's an option that gives them the right to buy at a lower price, so it has value. So in both cases, either they keep again their capital not diluted, or they will have a compensation for it. So this is what we call rights issue. And it's a cheaper way for the company to raise money also. If we compare the cost of issuing rights to the cost of issuing the new stock, this is much cheaper. The process is less, it's less heavy actually when you issue rights. So that's why it could be also a good way. But this, of course, the condition here is that you have wealthy existing shareholders who are willing to put the money. Okay. Otherwise, they will sell their rights, but this again they need to find a market for this. So in terms of cost, you can see that we go from the highest to the lowest. The highest being going public, going directly to the market. The lowest issuing rights. Okay. For the debt, we have the same idea. Of course, bank loans. Typically, we go and borrow money from a bank, or we can issue bonds, what we call corporate bonds, in the market. And we have two ways also to market these bonds, either through a general subscription, where the public is invited to subscribe, or through private placement. So we will issue bonds, but we will target specific investors in the market who are willing to put the cash. And usually they put big amounts of money. It's not like public where every investor will have less money to put. And of course here, as we said, there is other hybrids that are in between that also go through the subscription process or the private placement process as well. Now, the question here is the financing mix, as we said, in terms of what we want to understand behind all this. So again, all what I'm talking about can lead to different types of research. We can simply focus on IPOs, or we can simply focus on how to operate, how to issue bonds, or comparing a private placement to a public placement, etc. But the main question remains the same. It's how this mix between debt and equity can create value or not, okay? Whether it creates value or not, and how. So what are the benefits of using debt versus equity, and what are the costs also of using debt versus equity? So these are the main questions that have been discussed in the literature, yes?
I recall that there is kind of a ratio, like for the debt equity ratio.
Yes, it's either, actually, when we talk about debt, it's a ratio, as you said. It's either debt to equity or debt to total assets.
Okay.
So here, for example, if I have, let's say my capital is 100, okay, and my debt is 40, my equity is 60. Okay, I can have a debt to equity ratio, which is 40 to 60, okay, which is 2/3, or I can measure it as what's the percentage of debt out of my total assets, in which case my debt will be 40%, my equity will be 60%. So it's either debt over total assets or debt to equity.
Are there any ready models that corporate can adopt or use for that meeting their requirements? And for example, if I'm a CEO in a company and I would like just to
know
reach,
how much debt you
and I just would like to compare my situation to any available model in the market that I can.
Yeah, actually, we will go through some ideas here that maybe will clarify this for you, but there is no model that will tell you, well, this is how much debt you should have, okay? But what we will see from observing what happens in the business, etc., is that is the trend, the tendency. So as I said, what the theory tells you, if you want to talk about model, it's based on theory, based on assumption. What the theory tells you, it's the extreme case of what Modigliani Miller said is, doesn't matter. Don't bother. Doesn't matter how much debt you have. At the end of the day, what matters is the quality of the assets you have. Okay? Whether you use debt or equity, it doesn't matter. I will show you how they reach this conclusion, under which assumption. After that, we try to say, okay, yes, it doesn't matter, but this is not completely realistic because we know that there is this factor or there is this other factor, etc. So that's the process I will take you through. And something, for example, related to what you mentioned, that we observe is that there is somehow a kind of mimetism in the market, in the sense that companies, if you look at debt ratios, you will see that within the same industry, debt ratios will be quite similar. Okay, so for example, in retail, you will not have the same debt ratio as in construction or as in, I don't know what other sector, or in oil and gas, etc. And this, again, I will talk about it later. This depends on the characteristics of the business itself, but it's also because people are watching each other. So when a business will always look at the peers, okay? We will always try not to be too far away from, because it's again related to the signal you are sending to the market. Let's say you are operating in oil and gas, and in oil and gas people are used to see 20% debt, for example, huh? But your business is at 60% debt. What signal are you sending? Even if it could be completely healthy and there is nothing wrong about it, but managers will not want to be in this situation, because it's as if they are telling the market that they are at a higher bankruptcy risk compared to their peers. It might not be true, but compared to the peers, we will be under the impression that the debt ratio is very high. Okay, so there is no model that will tell you how much, but you have to look around you and see what businesses in the. That's why I said last time the market is a very important source of information, because we look, even if you are operating in a sector, in a business that is not listed in the market, etc., you can look at what companies listed in the market are doing, what is their debt ratios, and compare yourself there. Okay, and I will talk about other factors that may help you see where you stand, whether your debt ratios are high, low, depends on what are the factors that matter. Okay, so you can have a regression model with different variables, etc. Yes, but you will not have an answer saying, well, for this type of business, your debt ratio should be this much. Okay, here is the role of the manager actually to be, and I will show you also in a moment a survey that shows what matters in the mind of the managers when they decide on their debt ratio. What are the things they think about? Okay, there is a survey, international survey, that has been done, and it shows you exactly what they have in mind when they decide on their level of debt.
Like a behavioral factor.
Yeah, it could be behavioral. We'll talk about behavioral factors later. Yes, it could be a mix of things. You will see the factors, okay? We'll not anticipate. So, if we want to summarize, this is what we call a trade-off. By the way, we call it trade-off theory because there are a group of models that we classify under the trade-off theory, because the idea is that there are pros and cons for having debt. So it's the trade-off that matters. We have more pros, more cons, and whether one or the other wins will make it worth it or not. So what are the pros of having debt, or the advantages of having debt? We talked about the tax benefits, and we talked last time, for those who are not here, we talked about the fact that debt brings discipline to the management. It puts the manager under pressure to be performing, to be better performing. Okay? So these are the two advantages of debt. Tax benefit if there is taxation. So here, for example, in UAE, there is no tax benefit. So we would think of debt as bringing more discipline to the management, okay, since we don't benefit really from taxation. On the other hand, the disadvantages of debt, we discussed them also last time. Bankruptcy cost. Debt puts you under a higher risk of bankruptcy, and this risk comes with a cost. There are direct and indirect costs. Risk doesn't mean that it's going to happen, but even the likelihood, the probability that the company can go bankrupt because of this debt. If we reach high levels of debt, generates costs. For example, in terms of reputation. Think of, when I first came here in UAE, I remember I had to buy a car, and at that time, General Motors was having trouble, big trouble, and it was really like about to go bankrupt, and it was bailed out by the government after.
2007,
Around, I came here 2009.
2009.
I remember that was the period, the moment. It starts in 2008, I think.
Okay.
And so, because of all this, even now General Motors still exists, but it was no question that I would buy a General Motors car for me in my mind, because this company can disappear, right? And you will find yourself in a car that you will have trouble to find the spare parts, etc.
Why did you put in your mind this? Why
No,
did you put
I was reading newspaper articles. It was really
in
imminent.
UAE or in
No,
US?
in US, not in UAE, not the agency in UAE. No, in US, the whole company was about to collapse. It's the government, the US government, that saved it.
Bailed them out.
Yeah, they bailed them out.
They have a problem in Detroit actually, and the headquarters of the GM.
Yeah,
In 2007.
yeah, it started there, and it's
Detroit and
exactly. So it was just to tell you that this is a cost. The drop in sales because of the likelihood that the company goes bankrupt is a cost of bankruptcy. Okay, and again, bankruptcy doesn't happen for companies that don't have debt. Bankruptcy only affects companies that have debt. If you have only equity, you can never go bankrupt.
Like
It's
Thomas,
only companies that borrow money that can go bankrupt.
Thomas Cook actually is a recent example.
Thomas Cook, they have debt.
Actually, their agent in Egypt is owed 127 million Egyptian pounds. So
21 forever. They filed for
Yeah.
yesterday.
Yeah. So yeah, these are examples of, and again, even the company is already bankrupt now, but I think they were smart enough to keep it very quiet because people didn't see it coming. Otherwise, you will have no tourists going, because they had to repatriate their tourists. So it means that people didn't know. Otherwise, if you were to travel and you know that the company is going bankrupt, you never go and buy a package with this company, right? This is what I'm talking about. So there is a loss related to the probability of bankruptcy, which we call bankruptcy costs. Another disadvantage of that is the agency costs. Here, what type of agency? We talked about agency problems last time.
Conflict.
But here it's a different type of conflict. Agency problems can be everywhere. We talked last time about the conflict between the manager and the shareholder. Here it's the conflict between whom and whom. We're talking about debt. It's a conflict of interest, not conflict. They're not fighting. It's a conflict of interest between debt holders and equity holders, right? Debt holders want their money back. Equity holders will try to retain as much as possible cash in the business. So, and who has the control?
management,
Holders or equity holders?
equity.
Equity holders. Equity holders have the control until we reach bankruptcy. Bankruptcy, actually, how we define bankruptcy is when equity holders lose the control. Bankruptcy means the company becomes
Insolvent.
owned by the debt holders. So we lose the control only in case of bankruptcy. But when we reach there, even debt holders will not find anything left to take. So this is exactly the conflict of interest. Shareholders, they will try to get as much as possible before we go bankrupt, because after that, they know that they lose the control, right? So this is the kind of agency cost that exists when we have debt. These conflicts of interest don't exist when we don't have debt, but when we have debt, everyone is trying to get this, and there is a fight of power here, and who is the most powerful? Equity holders. So how do debt holders protect themselves? how do debt holders can protect themselves against this conflict of interest, these agency problems? By putting conditions, actually. If you are a bank, if you are a big bank and the business needs you to borrow money, you will put your conditions and you will be watching and you will be asking for financial statements and you will be following and monitoring what the company is doing, right? That's how it works. But if you go to the public as an investor, do I know what's going on in the company? If I buy bonds, for example, if I lend the money by being a bondholder, I don't really know. So that's why usually bonds come with what we call covenants. Covenants are clauses in the contract to protect the bondholders. For example, we will say the company is not allowed to distribute that much dividend or to distribute dividends if it's not generating that much earnings. So we will put conditions like this to avoid that the equity holders take the money, take all the cash and leave the bondholders without. So there is a solution to this, but it's again a partial solution. We cannot completely solve this agency problem, and this comes with a cost that is considered as a disadvantage of debt. Whenever you have cost, a cost is something that reduces the value, while of course an advantage will increase the value, basically. Yeah? And the last disadvantage of debt is the loss of flexibility. You will see how important this later when we ask the CFOs what they think about debt. Actually, loss of flexibility is something even at the personal level we experience it. If you go and take a loan today and you use it to buy a fancy car, in 2 years, if you want to buy a nice house, you will not be able to borrow money anymore because you reached already your limit, maybe, right? So we say that debt reduces your financial flexibility because what you borrow now, you borrow the cash now, you use it for some investments or for anything. Later, you will not be able to borrow. So if you have better opportunities later, you will not be able
You can see
to
it
borrow.
only. You can see it only without.
Exactly. And you will then think, oh, I shouldn't have borrowed, I shouldn't have bought this car because now I can buy this nice house I wanted, etc. So this exactly for at the business level is the same idea. It's you borrow money now to invest in some projects. It's better be worth it because if you invest in a project now and tomorrow you have a better project, but you already used all your borrowing capacity, then you will not be able to invest in the new project. So that's what we mean by financial flexibility here. Okay? So these are all the factors that matter when it comes to the trade-off between debt and equity. And these are the answers to the survey I mentioned. When we asked CFOs what they have in mind or what are the most important factors when it comes to financing, their financing decisions, when they decide whether they should go for more debt or not. These are the answers they gave, from ranking from 0 to 5, from less important to more important. What they classify as the most important thing is financial flexibility. So they don't want to use all their borrowing capacity because they want to keep the flexibility for the future. But, yes, go ahead, maybe you want to say something.
2 points. Number one, is it part of the ownership? Like equity, I lose the control because the ownership has been distributed to the shareholders. While in a debit, I can still control things because I'm still the manager.
Yes, yes.
Is
When
this
you borrow
the
money, you mean?
Yes.
Mm-hmm.
Is this the same when you're talking about the financial flexibility also?
No. Financial flexibility is
As you
like
explained
the opportunity cost related to missed opportunities in the future. Because you borrow now, you will maybe miss other opportunities in the future.
Okay. This
This is
will
exactly the
take me
financial
to the other
flexibility.
thing that
Yeah.
maybe we can add as a factor also the ownership
Yes?
as a factor, one of the factors. Some companies they don't want to take equity because of the
They don't want to issue new stock, you mean?
yes
Yes.
because
Because
they don't want to distribute the ownership.
Yes.
So this is for me maybe the number one factor.
Control, you mean?
Yes.
Keeping the control, yes. Actually, it's not here. It is maybe somewhere in the agency problem. One of the factors is agency problem, but it's not listed here. So the first thing they have in mind, the CFOs, the managers. Now we're not talking about the owners here, because here you need to keep in mind
Yes.
the agency problem also. The perspective of the manager is not necessarily the same as what the owners want. Okay? The managers have also a conflict of interest with the owners that will not make them always operate in the best interest of the owners, okay? So they want to maintain financial flexibility. For me, it's a hidden, this is my impression, This is really my impression. When they say we want to keep financial flexibility, it's more like saying we want to keep the cash. Remember what I said last time? Managers want more cash
Misuse.
because the more cash they have, the more comfortable they feel, okay? They want to keep the cash. They don't want to have a lot of cash used. So having debt brings more discipline to them, and that's what they want like. So less flexibility for them is probably more discipline also, okay? Ensure long-term survival. So this is consistent with the idea of bankruptcy cost. They are thinking of bankruptcy here, okay? Third one, maximizing predictable sources of funds. So here again, it's also linked to the flexibility, maintaining, predictable sources of funds. This is linked to the idea of flexibility. The less you borrow now, the more you know what sources of funding you can have in the future, okay? Maximizing stock price. Here, you see at the fourth position, we reach the idea of value maximization. Remember what we said? Theoretically, everything should be driven by value maximization. And managers should be operating in the best interest of shareholders and maximizing their value. But in their mind, it comes only at the fourth position. They think of value maximization in the fourth position. They think first about survival and flexibility. Survival, because if the company doesn't survive, they don't survive also. And flexibility also because, again, if they have a lot of pressure through debt, they will not have their hands free, okay? So you see here, implicitly, the numbers are telling us that there is a conflict of interest here between shareholders and managers. Number 5, maintaining financial independence. They want to be independent. Again, the idea of having their hands free. They don't want anyone to control them. They don't want the bank to come and see what they're doing, or financial markets watching also what they're doing. So by having less debt, they are more independent. Maintaining high debt rating. So this is in terms of rating and the signal that you send to the market. The more debt you have, the more likely your rating will go down. If you exceed a certain level of debt ratio, the rating will go down because you become at a higher risk of bankruptcy. And the last one is maintain comparability with peer group, what we discussed before. We always keep, the CFO will always, or the CEO will always keep an eye on what the peer group, the companies that belong to the same industry are having or are doing, okay? So these are the 7 factors that were identified, and it would be actually the authors of this paper who did the survey. They contacted us, a colleague of mine contacted them, and they wanted to do the same here with the same instrument. And the instrument is ready, everything that we have. We need the time to do the survey. I'm not really a survey person, so I was asked to be part of this of the team, but I found it very time-consuming. Survey is a headache. You have to contact all CFOs in UAE. They have to accept to answer your questions, and it's not
Who's doing
This could be a good topic for a dissertation because you have time, 3 years or 4 years. But for a paper, it's it's a lot of investment for a paper. Yes, go ahead. You want to ask something? I said, who are the authors?
I wanted to say who's doing the surveys here
You mean,
for,
are there any
for
contents?
research?
Well, either you hire